Hey everyone, and welcome back to the channel. Today, we're diving deep into one of the most talked about stocks on the planet, Tesla. The markets have been on a wild ride, and Tesla is right at the center of the storm. The stock has seen a significant drop recently, and it's got a lot of investors asking some tough questions. Is the massive hype around electric cars, self-driving robotaxis, and groundbreaking AI enough to justify its sky-high valuation? Today, we're going to break down the top reasons behind this recent dip and explore what it could mean for the future of the company and its investors. So, let's set the scene. As of December 2025, Tesla stock is trading at around $430 per share. Now, that's not too far from its recent highs, but the pressure is definitely on. We have seen several red flags pop up lately that have spooked the market and triggered a bit of a sell-off. And when the market gets nervous about Tesla, you know the headlines are going to follow. One of the biggest headlines came from a very familiar name, Michael Burry. If you don't know who he is, he's the investor famous for predicting the 2008 financial crisis, a story immortalized in the book and movie The Big Short. When he talks, people listen. And recently, he's been talking about Tesla, calling its valuation ridiculously overvalued. Burry's warning isn't just about the price tag, which he believes is in a bubble. He's also pointing to a major concern for current shareholders: dilution. He suggested that Tesla might need to issue new shares to fund its operations or, more controversially, to pay its CEO, Elon Musk. When a company issues new shares, it's like cutting a pizza into more slices. Each existing slice or share becomes a smaller piece of the whole pie, which can shrink its value. This brings us to one of the most debated topics surrounding Tesla right now: Elon Musk's compensation plan. Just last month, Tesla's board and its shareholders gave the green light to a staggering $1 trillion compensation package for Musk. Now, this isn't just a simple paycheck. It's tied to a set of incredibly ambitious milestones. We're talking about goals that sound like they race straight out of a science fiction movie. For Musk to get his full payout, he needs to raise Tesla's valuation to an astronomical $8.5 trillion. To put that into perspective, that's more than the GDP of most countries. He also needs to oversee the delivery of 20 million cars a year and deploy a fleet of 1 million robotaxis. Critics are calling this plan extreme, and it's easy to see why. The risk here is twofold. First, what happens if Tesla fails to hit these moonshot goals? The market has priced in a lot of future success, so any failure to deliver could cause the stock to plummet. But here is the other side of the coin. What if Tesla does meet some of these targets? To pay Musk, the company would likely issue a massive number of new shares. This could lead to that dilution we just talked about, where existing shareholders see the value of their investment watered down. It's a classic catch-22 for investors. Beyond the internal drama of compensation plans, there are some external signs that the road ahead might be getting a little bumpy for Tesla. We're starting to see potential signs of softening demand. In key markets like Europe and China, registration data for new Tesla vehicles has shown a noticeable drop. This is a big deal because these regions have been huge growth drivers for the company. When you combine this with broader macroeconomic headwinds, things like higher interest rates making car loans more expensive and a flood of new competition from both legacy automakers and new EV startups, that optimistic growth story starts to look a bit shaky. The days of Tesla having the EV market all to itself are long gone. Now, it wouldn't be a fair analysis without looking at the other side, the bull case for Tesla. And let's be honest, it's a powerful one. The argument is that Tesla isn't just a car company anymore, and valuing it like one is a huge mistake. The real bet is on the future. It's a bet on robotaxis completely revolutionizing transportation and creating a new, massive revenue stream. It's a bet on artificial intelligence, with projects like the Optimus humanoid robot potentially changing labor and manufacturing as we know it. These are the futuristic plays that could transform not just one, but multiple global industries. If even one of these bets pays off in a big way, the current valuation might look cheap in hindsight. And this is a big, but these are still just bets. They rely on flawless execution, technological breakthroughs that haven't happened yet, and a market that continues to favor these kinds of ambitious, moonshot investments. If Tesla stumbles on execution, if the robotaxi software isn't ready, or if the market sentiment shifts away from high-risk, high-reward growth stocks, the downside could be very steep. The same things that make Tesla so exciting are also what make it so risky. So, if you're an investor trying to make sense of all this, what should you be watching? I'd break it down into 4 key areas. First, execution. Keep a close eye on the fundamentals, vehicle sales numbers, progress on the robotaxi network, and demand trends in those key global markets. Are they delivering on their promises? Second, dilution. Watch for any announcements about new share issuances. How is the company funding its growth and that massive CEO compensation plan? Third, market conditions. Pay attention to interest rates, overall consumer demand for EVs, and how the competition is performing. These external factors can have a huge impact on Tesla's bottom line. And finally, governance. How is the company being managed? Is the board handling leadership compensation and its ambitious growth promises in a responsible way that aligns with shareholder interests? Ultimately, there is no denying that Tesla is one of the most exciting and innovative companies in the world, perhaps more than any other automaker. But with that excitement comes a level of risk and volatility that is not for the faint of heart. If you are an investor who is all in on the long-term vision and can stomach the wild swings, then you're probably already buckled up for the ride. But if you're someone who prefers more stability and predictable returns, this might be a stock to watch from the sidelines for a while. As always, the key is to balance ambition with caution and to do your own research. What do you think? Is Tesla overvalued, or is this just a temporary dip before the next big surge? Let me know your thoughts down in the comments below. I read every single one. Thanks so much for watching, and if you found this video helpful, be sure to hit that like button and subscribe for more deep dives into the stocks and market trends that matter. I'll see you in the next one.